Hi, good afternoon. Thank you so much for making time and speaking with us. Let me start with a tad bit of macro question when it comes to the Q3 earnings because we are just at the cusp of that. Which sectors do you think are poised for a bit of a surprise, and which are the sectors which you think might actually disappoint? Because there's a lot of nervousness as it is around, let's say, IT sector, cement space, etc. What's your own sense?
Well, for the upcoming result season, there are some sober expectations from sectors like IT or businesses which face, demands in Europe or US kind of geographies. It would be crucial to watch what happens on the revenue trajectory there, as well as how do the management commentary come across. But more importantly, I think on the domestic side, for the last 18 months, we've seen consumption-oriented businesses languish, particularly if you are on the entry-level SKUs. So that is something that will be closely, keenly dealt with in terms of how does the management trajectory and volumes come across. Impact of inflation on lower income households, and particularly businesses facing the government and capex spending. So cap goods, textiles, chemicals, cement, and the like. So we expect market to actually be more forward-looking in terms of how the earnings kind of pan themselves out. What I mean by that is it is expected that there will be somber results on the export-oriented businesses, but the domestic-oriented businesses are expected to do a bit better. So let's see how things pan out. It's a function of how businesses deliver versus the broader market expectations. So we just entered that, and let's see how things pan out on that space.
Okay, but let's get a bit more specific. When you say that you expect domestics to do better, which are those themes? Is it, let's say, the manufacturing theme? Is it capex based industrials? Is it autos? Which space is looking stronger to you? And if you can talk to us about your stock specific recommendations as well.
Auto ancillary and auto, they clearly have had a good volume trajectory in the last 3 months, and that is a continuation of almost 1.5 years. We continue to see demand, particularly from the urban side of things. So in auto ancillary, we clearly have preference for businesses which feed into not only the traditional internal combustion types, but also potentially are investing towards the electric mobility or the greener mobility of the future. So those are things that are of interest to us. We find the mortgage businesses clocking very good volumes, the housing mortgage. The cement have been, all over the place, but let's see how the cement things come across. We also like healthcare as a space, particularly businesses benefiting out of PLI, and in the capex mode in particular. We are yet to figure out how to step into electronic manufacturing space that is seeing a lot of traction. So we generally avoid taking stock specific names, but largely to do with auto ancillary, healthcare, PLI beneficiaries, and the value chain, in that space is where we are largely placed and interested.
Right. How would you look at the power infra space? As you said, power utility, cap goods are among your top picks. What to watch out for? Last year has been good. Order inflow has come in. What to watch out in execution for this year?
So clearly, as most capex comes on stream, there will be higher demand for industrial power. We've had very low investments in power capacity creation in last 10 years because it was a significant contributor to NPA in the last cycle. Huge amount of power capacity got created. So we've largely used whatever capacity came on stream in the last 10 years into domestic demand fulfillment. So as industrial activity picks up, I think there will be some demand supply mismatches that will happen, and consumables and power utilities, the entire power utilities and cap good space, it kind of, will start seeing propulsion, I think sometime during the calendar year. We also think that time has come for rural part of the economy to revive. It's an extremely dormant place for the last almost 24 months. We've largely seen the urban India doing well. And now I think it's time for rural part of the economy to actually pick up, and that is very large volume. So for most businesses, rural is a very large volume businesses, and lower entry level SKUs is where actually it gets largely played into.
Right. In terms of valuation, despite any correction that we've seen across sectors, where do you see there is valuation comfort despite things have not turned out maybe in the favor, and that's why probably valuations are where they are. So, what's a real value pick in terms of any sector or stock?
So, very relevant question. If we see the calendar year, the large cap index delivered in the calendar year 22 somewhere around 4 odd percent, wherein the small cap was down around 13 odd percent. So clearly we are seeing more valuation comfort in the small cap space compared to large cap space. That's very, very clear. And it's a very large space, frankly. So there is a huge dispersion. And investing in small cap or mid cap is more about picking up the right business for a right price. So we do see very interesting prices in businesses to do with transformers, businesses to do with auto ancillary space, and across healthcare. So we have a lot of businesses which actually are very interestingly priced in the small cap space in particular, somewhat in mid cap space also, and sporadically in the large cap space. So that's largely our stack of value. We find far more options which fulfill the value zone in small cap, followed by mid cap, followed by large cap. That's how we see the stack.
We'll let you go on that note. Thank you so much for joining us. So small cap space is where the valuation comforted, and that's quite understandable given the 14% correction that we saw in that index in the year gone by. But